Hey everyone, and welcome back to our channel. Today we're going to be discussing a topic that's important for anyone who invests in the stock market: value traps. Now, you might be wondering, what exactly is a value trap? Well, a value trap is a stock that appears to be undervalued based on certain financial metrics, but in reality is actually a bad investment. In other words, a value trap is a stock that looks like a great deal, but ends up being a bad investment in the long run. In this video, we're going to explain why value traps exist and how you can avoid them. Now, let's talk about why value traps exist. One of the main reasons why value traps exist is because investors often rely too heavily on financial metrics like price-to-earnings ratios, PE ratios, and price-to-book ratios, PB ratios, when they're evaluating stocks. While these metrics can be useful in some cases, they don't always tell the whole story. For example, a company might have a low PE ratio because its earnings are declining, or a low PB ratio because its assets are outdated or overvalued. These are the types of red flags that can indicate a value trap. Another reason why value traps exist is because of the stock market's tendency to be cyclical. This means that certain sectors or industries might be in favor at one point in time, and out of favor at another. When an industry or sector falls out of favor, investors might pile into stocks that seem cheap, hoping that they'll bounce back. However, just because a stock is cheap doesn't mean it's a good investment. It's important to consider the long-term outlook for the industry or sector before you invest. So, how can you avoid value traps? The first step is to do your research. Don't rely solely on financial metrics to make your investment decisions. Look at a company's fundamentals, like its earnings growth, revenue growth, and debt levels. Also, consider the industry or sector in which the company operates. Is it a growing industry or a declining one? Is the company well positioned to take advantage of future growth opportunities? These are the types of questions you should be asking before you invest. Another way to avoid value traps is to diversify your portfolio. Don't put all of your money into one or two stocks, even if they seem like great deals. Instead, spread your money across a variety of stocks and industries. This will help you mitigate your risk and protect your portfolio from the effects of any single value trap. So, there you have it. Everything you need to know about value traps and how to avoid them. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more great content like this. And if you have any questions or comments, leave them down below. We'd love to hear from you. Thanks for tuning in, and we'll see you in the next video. In conclusion, value traps can be a serious problem for investors, but they're not impossible to avoid. By doing your research, diversifying your portfolio, and considering the long-term outlook for the industry or sector in which a company operates, you can protect yourself from the dangers of value traps. Remember, just because a stock looks like a great deal, doesn't mean it's a good investment. Thanks for watching, and we'll see you next time.